Good morning, everyone. Well, the U.S. and the European Union yesterday unveiled a set of sanctions in response to Crimea's action in breaking away from Ukraine. Both governments limited the scope of these initial sanctions to travel restrictions and asset freezes, targeting specific Russian, Ukrainian, and Crimean leaders. Washington and Brussels did not sanction the same officials, however. The U.S. sanctions target senior members of the Russian elite, while the EU sanctions hit less significant individuals, many of whom are Ukrainian or Crimean, which doesn't really matter to Russia. The discrepancy illuminates the wide gap that exists between the two partners. The weakness of this initial move was a relief to the market, and the risk premium in the market eased. The VIX index fell, U.S. bond yields rose, gold and oil collapsed, and the dollar generally weakened. The best performing currency? The ruble, as Russian stocks soared around 4%. In the G10, most currencies gained against the dollar, except for the safe haven yen, which lost some of its appeal because nobody needed a safe haven. The Swedish krona and Norwegian krone, the currencies of the two countries that send most of their exports to Europe, performed the best within the G10. Now, the discrepancy between the U.S. and the EU sanctions highlights the different risks that both sides are running. Europe is much more exposed to any countermoves by Russia. The U.S., on the other hand, sees this as an opportunity to curb Russia's recent resurgence in its periphery and to prove to Eastern Europe that it's a reliable foreign policy partner. Getting back at Russia for the Snowden affair must also be tempting. Washington and Brussels both said that they'll reconsider their response after hearing what President Putin says today. It remains to be seen whether Washington and Brussels can close the gap with more significant sanctions or whether Russia will just successfully play off the different interests that the two sides have. Either way, we haven't heard the end of this drama by any means. Now, today is the first day of the March FOMC meeting. This is the first meeting chaired by the new FOMC chair, Janet Yellen, and it'll be her first press conference as FOMC head. I'd guess that nobody really expects any change in the tapering process. That is, the committee is likely to reduce its monthly bond purchases by another $10 billion. There is likely to be a change in the presentation of the FOMC's forward guidance, however, much like occurred in the UK. The experience of the Bank of England shows that this change could support the dollar. As for the indicators, the main one during the European day will be the German ZEW survey for March. The current situation index is forecast to rise, while the expectation index is expected to fall, so it's hard to say what the market reaction is going to be. I expect it will ignore the data and focus on Russia. Separately, Eurozone's trade surplus is expected to have risen slightly in January. That's normally not a market-moving event. As for the U.S. indicators, the pace of increase in the CPI is forecast to plunge in the U.S. to 1.2% year-on-year from 1.6%. And both the housing starts and building permits for February are expected to have improved. But, as I said, I don't think any of that will matter as everyone watches Russia. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Gittler, Global Head of FX Strategy at IronFX Global, wishing you solid trading.